Okay, real talk for a second. We've all seen this movie before. Silver spikes on hype or fear, it captures headlines, everyone gets excited, and then, predictably, it crashes. It deflates. It always comes back down to earth. For half a century, that was the unshakable rule. No matter how high it flew, silver would always return to what the market called cheap. But I need you to look closely at what's happening right now in 2025. This isn't another rerun. The pattern you think you know has shattered. Something in the fundamental machinery of the market has broken. And if you're sitting on the sidelines, waiting for silver to get cheap again, you need to understand that you might be waiting for a moment in history that is already behind us. Let's rewind and understand that old rhythm, because it's crucial to seeing the break. For 50 years, silver wasn't primarily driven by how much we needed it to build things. It was driven by human emotion. It was a pendulum swinging between two powerful feelings, monetary fear and speculative greed. It was a bet against the system, or a bet on a get-rich-quick scheme. Think about the iconic examples. 1980. The Hunt brothers, convinced paper money was doomed, tried to literally corner the global physical market. They amassed a hoard so vast it was compared to a national treasury. They pushed silver from single digits to $50 an ounce. But it was a castle built on borrowed money, on leverage. When regulators changed the rules and the margin calls came, the castle turned to sand. Silver didn't just fall, it was obliterated, crashing over 90%. The lesson? Demand built on manipulation is fragile. It collapses under its own weight. Then, 2011. The world was still trembling from the 2008 financial crisis. Central banks were printing money at a scale never seen before. The genuine fear was a collapsing dollar and runaway inflation. Silver became the poster child for that fear, soaring from $30 to nearly $50. But once again, this was a monetary trade, a bet on the failure of other assets. When the immediate panic of hyperinflation didn't materialize, the hot money that had rushed in rushed right back out. The result was a dizzying 30% crash in just 5 days, the start of a brutal 70% decline that took 4 long years. The lesson? Demand built solely on fear is fickle. It abandons the market the moment the fear subsides. Even the 2021 attempt was telling. Fueled by the energy of the GameStop saga, a wave of retail investors tried to will a silver mark, short squeeze, into existence through sheer force of online coordination. It produced a blip, a brief jump, that faded in a matter of days. Why? Because you cannot hashtag 1 billion ounces of physical metal into existence. The scale was all wrong. The lesson? Hype cannot manufacture the kind of tangible physical demand that sustains a price revolution. In every single case, the rally was fueled by something temporary, a manipulative plot, a panic, a social media trend. And when that fuel ran out, the engine stalled. The metal would flood back onto the market, and the price would obediently sink back to its long-term baseline, that comfortable, familiar, cheap zone between $15 and $25, where it would wait for the next emotional spark. That was the cycle. Until now. The 2025 rally is a different beast entirely. Listen closely. This is not a story about psychology. This is a story about accounting. It's about physics. It's about irreversible arithmetic. The old playbook has been torn up and replaced with 3 new, non-negotiable rules that have permanently rewired the market's circuitry. Rule 1. The era of the surplus is over. We now live in a permanent structural deficit. Forget temporary imbalances. What we have now is a relentless mathematical reality. For 7 consecutive years, since 2018, the entire world has consumed more physical silver than it has pulled from the ground. This isn't a quarterly miss, it's an annual tradition. The cumulative weight of these deficits is staggering, over 1.2 billion ounces. To wrap your head around that number, understand that the entire global mining industry produces roughly 800 million ounces in a good year. We have effectively consumed an extra year and a half of global production, but we never mind it. Where did it come from? The stockpile. The strategic inventories in London, Zurich, and Shanghai. The vaults that, for generations, acted as the market's shock absorber, releasing metal when demand spiked and soaking it up when demand faded. Those vaults are now critically depleted. Reports from the Shanghai Futures Exchange show inventories at their lowest levels in a decade, draining by tens of tons every single week. You cannot correct a billion-ounce deficit with optimistic sentiment. You can only fill it with metal that does not exist. Rule 2. Demand has become a one-way street. Industrial consumption is a black hole. This is the most profound break from the past. Historically, a large portion of silver demand was cyclical or recoverable. Jewelry could be melted, coins and bars could be sold back to a dealer. Today, over 60% and growing of annual silver demand is industrial, and this isn't a suggestion, it's a mandate. More importantly, it is largely non-recoverable in any meaningful time frame. Follow the metal. It goes into the photovoltaic paste of a solar panel. That panel is then installed on a roof in California or in a vast solar farm in Texas, where it will operate, silently converting sunlight for 25 to 30 years. The silver is technologically locked in, chemically bonded, and economically impossible to extract at current prices. It is gone. It goes into the multiple electrical contacts, sensors, and infotainment systems of an electric vehicle. Every single EV uses roughly twice the silver of a traditional internal combustion car. That vehicle is sold and will be on the road for a decade or more. Its silver is off the market. It goes into the solars and microcapacitors of hundreds of millions of smartphones, laptops, and the vast server farms that are the physical backbone of the artificial intelligence revolution. This silver is scattered to the winds in a global electronic ecosystem, effectively lost. This demand is not based on a feeling. It is based on the U.S. Inflation Reduction Act. It is based on Europe's Green Deal. It is based on China's 5-year plans and the capital expenditure budgets of every major tech and auto company on the planet. It is policy-driven and infrastructure-driven. It is sticky, persistent, and, most crucially, cumulative. Every single year, we permanently sequester another 200 to 250 million ounces of silver into the built infrastructure of the 21st century. This creates a relentless, one-way drain that the silver market has never, ever experienced in its long history. Rule 3, silver is no longer just a commodity. It is a geopolitical strategic asset. The final rule change comes from the highest levels of power. In recent years, the United States, the European Union, and China have all formally added silver to their official lists of critical minerals. This is not an investment term. It is a national security and industrial policy designation. It is a declaration that silver is indispensable for clean energy, defense, and advanced computing technologies. This changes the entire game. It means governments will now actively intervene in the market, not to bust manipulators like the Hunts, but to secure supply. They will offer subsidies for domestic mining and recycling. They will build strategic national stockpiles, taking metal off the market entirely. They will impose export controls on processed materials. The era of a truly free, liquid, and global market for physical silver is fading. We are moving into an era of bifurcated supply chains. One stream for the open market, and another commandeered stream for national and allied industrial priorities. When the U.S. Department of Defense or a Chinese solar panel giant enters the market as a buyer, they are not looking at a price chart thinking, this is a bit high, I'll wait. They are thinking, we need this to meet our production quota or our strategic mandate. They are price insensitive. This creates a permanent, powerful bid underneath the market that exists completely outside the old cycles of fear and greed. So let's confront the big question head on. In this new world, what does cheap even mean? The old definition, a price hovering around the marginal cost of production for the least efficient mine, is now a nostalgic relic. That cost might be $22, but it's irrelevant. Why? Because the metal produced at that $22 cost is already pre-sold. It's already destined for a first solar factory in Ohio or a Longai panel facility in China before the ore is even processed. The new floor for silver is now set by a far more brutal and complex equation. It is set by the replacement cost. If we needed to magically materialize a new 100 million ounce mine tomorrow to plug the deficit, what would it cost? The answer involves 10 years of permitting battles, billions in capital expenditure, and immense environmental hurdles. The true cost is astronomical. The new floor is also set by the industrial pain threshold. What is the maximum price per ounce that an automaker like Tesla or Ford can absorb for the silver in their EV's wiring harness before the vehicle's profit margin evaporates? What can a panel manufacturer tolerate? These companies run on razor-thin marginal economics. That threshold number is a closely guarded secret, but one thing is certain. It is far, far north of $25. In this new reality, a sharp 20% or even 30% price correction from a peak is not a return to cheap. It is simply volatility within a secular, structurally driven bull market. It is a fire sale for industrial procurement officers who know the quarterly deficit report hasn't changed. The dips will be bought aggressively, not by day traders, but by corporations with quarterly production targets they absolutely must meet. Of course, we have to be clear-eyed. This is not a risk-free, one-way ticket to paradise. The most significant threat is a deep, prolonged global recession. If the economy seizes up, solar farm projects get delayed. EV sales stagnate as consumers pull back. 5G rollouts are postponed. Industrial demand, while sticky, is not immune to a macroeconomic hurricane. It could soften, and in the short term, that softening could overwhelm the deficit narrative, leading to a painful downturn. History shows this. In 2008, during a massive bull market for gold, silver still got cut in half during the liquidity crisis. And yes, the oldest rule in economics still holds. High prices are the cure for high prices. At $60 an ounce, recycling every old phone and computer becomes wildly profitable. New mining projects that were fantasy at $30 become bankable realities. But here's the catch. The cure operates on a 5 to 10 year lag. A mine permitted today might pour its first bar of silver in 2033. It does nothing to solve the shortage in 2025, 2026, or 2027. The deficit has a head start that the supply response simply cannot match. This demands a new framework for thinking about silver. You must discard the old tools. First, you must learn to separate volatility from risk. The price will swing wildly. That is a guarantee. But true risk is no longer a return to 20. True risk is misjudging the strength of the structural floor, which is now permanently elevated. Second, you must measure value against the deficit, not against a historical price chart. A silver chart from the 1990s is as relevant as a map of the world from the 1990s. The landscape is fundamentally different. The key metric is not how high is it compared to last year, but how many weeks of inventory are left in Shanghai. Third, you must watch the physical signals, not the financial headlines. The most important data points are the weekly inventory reports from the Shanghai Futures Exchange. They are the canary in the coal mine. Watch for backwardation in the futures market, where it costs more to buy silver for immediate delivery than for delivery in 3 months. This is the very definition of spot scarcity. Watch the amount of premiums people are paying to get a specific brand of bar or coin right now, over and above the spot price. These are the whispers of the physical market, and they tell a truer story than any analyst's report. Look, I'm not standing here telling you to mortgage your house and buy silver tomorrow. I'm trying to connect a series of dots that most of the financial world is still viewing as separate, unconnected points. They see the price and think, here we go again. But they're missing the seismic shift beneath their feet. The cheap silver of history, that reliable, patient asset you could always count on being there at a low price. That idea was dismantled by 3 converging forces: the arithmetic of cumulative deficits, the physics of industrial consumption, and the geopolitics of national security. So please do your own research. Don't take my narrative for it. Go download the World Silver Survey, track the weekly SFE inventory data, read the quarterly reports from solar giants like First Solar or panel material producers, listen to the earnings calls of semiconductor companies. The evidence isn't hidden, it's in plain sight, painting a coherent, undeniable picture of a market that has crossed a fundamental threshold. It's a disorienting feeling, isn't it? To watch something that behaved so predictably for so long suddenly operate by a completely new set of rules. It feels like the gears of the world have slipped. It leaves you with a very clear, very personal choice: to keep glancing in the rearview mirror, waiting for a past that is gone, or to adjust your focus and start navigating the new terrain that lies ahead. The point of no return isn't just a price on a screen. It's a line crossed in the collective understanding of what this metal is and what it means for our future.